Hello, welcome everyone. Thank you for taking the time today to learn more about the CARES Act, which was signed into law by the President last Friday, March 27th. During this webinar, I'm going to be sharing information in regards to how the Act affected the excess business loss limitation. Quickly, to cover the legal disclaimer, the material appearing in this presentation is for informational purposes only. It should not be construed as advice of any kind, including without limitation, legal, accounting, or investment advice. As a quick introduction, my name is Matt Montez, and I'm a partner at Moss Adams. And I'm an industry group tax leader for the construction, real estate, and hospitality space. While there are many business-friendly provisions included in the CARES Act, the suspension of the excess business loss limitation rules for tax years 2018, 2019, and 2020 may not be as well understood without further explanation. As a result of the recent tax reform provisions of the TCJA, business owners were subject to not 3, but 4 hurdles when determining whether they could claim a loss from their business activities. The first 2 hurdles require that a taxpayer has sufficient basis to deduct a loss. The third hurdle required a business owner to consider the passive loss limitation rules. And the fourth hurdle is the excess business loss limitations, which has now been suspended through tax year 2020. To explain the loss limitation, in effect, the fourth hurdle allowed non-corporate taxpayers to deduct business losses against no more than $250,000 of non-business income. That threshold increased to $500,000 for joint filers. The excess losses are to be carried forward as net operating loss carryforwards. Again, the CARES Act suspended this fourth hurdle for tax years 18, 19, and 2020. The CARES Act also included much needed technical amendments to the statute that include, and these will be applicable when the provision is again applicable in 2021. These included clarifying that the excess business loss is treated as a net operating loss for subsequent tax years, eligible for carry forward or carry back as applicable, stating that the excess business loss is computed without including NOLs or Section 199A deductions, clarifying that W-2 wages are not included in the excess business loss computation, and clarifying when certain capital gains attributable to certain trade or businesses are included in the computation of excess business loss. As noted previously, the CARES Act retroactively suspends the excess business loss limitation rules back to tax year 2018. Taxpayers should consider whether limitations were applied on their 2018 tax returns. If so, they may be eligible to amend their 2018 tax returns and request for a refund. Additionally, the suspension of the excess business loss limitation rules should be coupled with the changes in the net operating loss rules. To the extent a taxpayer is eligible to claim a net operating loss on their 2019 tax return, they may be eligible to carry back their NOL and file for a request for refund. This tax law change should prove to be beneficial to many taxpayers. While there are many acronyms used here and nuances to the rules, we highly encourage you to reach out to your Moss Adams professional as to how this change might impact you and your business. Thank you very much, and take care.